Welcome to TheoTrade. This is Don Kaufman. Here we are. It's March 9th, 2017. S&Ps have just about 5 minutes to go to the cash close, and they are going to finish the day, well, for the most part, as you see on the screen, massively unchanged. So S&P futures are pretty much unchanged today. However, we did have a little bit of Mr. Toad's wild ride during the intraday session. So I'll start out with number one. We had an ECB announcement this morning. For those of you that missed it, you missed absolutely nothing. Mario Draghi came out, did a speech. I often call him Ivan Drago. What did he say? Yada, yada, yada. They're tapering the purchasing of bonds over in Europe. Nothing new, nothing unexpected over there. The markets ultimately rallied off of it, faded just a bit throughout the course of the day. But then again, midday over here, if you look very carefully, real carefully there, that's even an intraday gap. Intraday gap with some heavy volume. We actually were off to the races to the downside and printed 23.54. I have to tell you, midday today, a lot of traders are chatting into me on Skype and, is this it? Like, is the dam about to break? Are we about to see Sellside Activity? And one thing I kept pointing out, I'm like, the volatility never really picked up all that much today. And until, again, we peaked out on volatility, but until we really see these volatility futures kick in, and when I say kick in, you got to see those volatility futures on fire. Like when they're up a point, up 2 points, you're going to know when the dam breaks and the Sellside Activity really kicks in. But one thing I want you to realize, okay, the S&Ps, so they rallied right back up to this 23.64. Now, if you tune in on a day-to-day basis here at TheoTrade, you'll know that I keep talking about the S&P, okay, and the SPX. The SPX right now, all it's doing is hovering into its expected move for the week. Now, again, if you're totally unaware of expected move, okay, just a really quick recap. Again, I've been doing this kind of day in and day out over here throughout the course of the week so we learn where the expected move is. Now, if you look back to Sunday, on Sunday night, there was about a $20 expected move. Okay, so I'm going to highlight a couple of things real briefly here. There's a $20 expected move. The week starts at $23.83. $20 lower takes us roughly where we are right now, $23.63. Okay, then that's roughly where we're going to close today. Now, if we start to break much below that, okay, so let's actually go over here to the chart, okay, and we zoom in. If we start to break much below this 23.63 level, we start getting down here, it'll actually kick in dynamic hedging. Dynamic hedging is the trading firms, they'll come in and actually start selling into selling. Why do they do that? It's to hedge off their risk. These firms have drastic risk when we start to get outside of the expected move. Okay, the expected move, again, the line in the sand over here is 23.63. So during today's trading session, right, we started to tumble underneath 23.63, and you saw exactly that. Huge sell-side activity started pouring into the marketplace. Now, we didn't get massively outside of it. Okay, we did rally back up, and the irony is that we're going to close right into the expected move. Now, time out for just a second. I also want to reiterate, tomorrow morning, there's a jobs report. That is Friday morning. There's going to be the unemployment situation. Well, I'll tell you what, we do have a situation because there's one very interesting facet that I think a lot of people are going to miss this week. Look at the expected move, okay? This is right here on Thursday. All right, we have like a couple of seconds to go to the close. Literally, there's a few seconds to go to the close here on a Thursday. And what I want you to see is the expected move. It's back up to $14. And you're like, oh, okay, what does that really mean? It's at $14 today. So the expected move's at $14. Yes. And on Sunday, the expected move for the entire week, okay, was sitting, first of all, we were sitting at a 7.36 vol, and we were looking at about a $20 move. So what have we seen as the week has progressed? The volatility is increasing. The volatility is increasing. So the underlying risk to the marketplace is picking up out there. And tomorrow, we have a 14-point move, okay? Told everything, people. This is a Friday. There's an unemployment situation. We got ourselves a $14 expected move. If I didn't know any better, this is going to be a trading session. Tomorrow, okay, we could be rocking a little bit, a $14 move. Listen, That was the range pretty much from high to low in there today, but a $14 move, that is what is expected. What's unexpected? There's the closing bell. What's unexpected? We could see $20, $30 move possibly tomorrow with anything coming out that would be the slightest hint of abnormal inside of course, that jobs report. The employment situation in the morning apparently is much more important than we had initially believed. Again, markets finished, the cash closed massively unchanged on the trading day. Volatility massively unchanged. The big mover on the day happened to be the bonds. The bonds, once again, they're getting tagged. Okay, and I have to tell you, this is a marketplace where undoubtedly I'm wrong. I have actually been a bit more bullish in bonds, and I've taken a defined risk bullish spread in bonds. I'm still bullish on bonds. Why am I bullish on bonds? I think that we're right on the cusp here of the S&P starting to see some sell-side activity. Listen, I don't know if this is going to be the big sell side that everybody's been looking for. Come on, people have been looking for the markets to sell off since 2009. Here we are in 2017, almost a decade later. We haven't had a lot of sell-side activity. Nevertheless, in the short term, okay, we see any real sell-side activity inside of the S&Ps. I expect traders, okay, will come running from the S&Ps, out of the S&Ps back into where? The bonds. Take the bonds a bit higher out there. That's why I've been bullish on the bond market. However, tomorrow's employment situation could be really serious for that. Everything else that you see on your screen is superfluous. When I say everything else on the screen, you know, people are like, well, Google's going to do this and Amazon's going to do this. Listen, it's just slush trade. Look at the advanced decline line out there, okay? Every day we're back to this 50-50, what I call slush trade. It's sloppy, doesn't have exactly a feel. Tomorrow, if we get some sell-side activity tomorrow, okay, we could have some action to the advanced decline line. But hey, listen, tomorrow there's a $14 expected move. And I want to reiterate a stance for tomorrow's trade. There's a $14 expected move coming into tomorrow's trading session. You know, that expected move over there, it doesn't lie. This is a binary decision. What a binary decision basically means, listen, we're going up or we're going down. So I don't want to hear about your Fibonacci's, your MACDs, and your Bollinger Bands. There's no technical for tomorrow, okay? I am going to give you some levels, though, to look out for, okay? Why am I talking levels? We got levels over here. First of all, as we know, the expected move in the S&Ps sits right around this 2363 level, okay? Cracking under, again, I'm going to zoom in here, cracking under 2363 tomorrow could be a bit more devastating. And again, I am not telling you which way the market's going to go, but I am telling you we start to sell off a bit tomorrow, okay, and the markets could tumble hard. Now, in addition to that 2363 level, we've also got a very firm level down here at 2349. 2349, we crack that, that would pretty much be the dam bursting. I think we cracked 2349. Now that's a distance, but there's an irony about that. What is the distance? 2349. Go look at the expected move inside of the SPX for me for a second. It's about 14 bucks. Ooh, woo, we are in striking distance of the dam bursting. That's the point that you got to see, is that all of a sudden we're sitting on a $14 expected move, the market sitting at about 2364. So that takes it right down to what, 2350? Close enough. We come into that, again, 2349 level, things could get nutty in a hurry out there. We've seen tremendous volume. Now, never count out a bounce to the upside. However, at this point in time, okay, a bounce to the upside could also be reasoning for traders to come in. They'll look to sell it. If markets open tomorrow drastically higher, you got to be careful. Again, tomorrow is very much a binary trading day, but I'm warning you, if markets open extremely strong tomorrow, they may come in and hit them as the day progresses out there. Keep this in mind. Again, this jobs number could really rock the bond market either direction. That's what makes it so binary. And that binary, what does it mean? Hey, it's a 0 or a 1. We're either going to be, you know, smoking to the upside or falling. But a $14 expected move, okay, you have to respect the risk, okay, that the market's displaying. And this is the most risk that the market is displayed for any one trading day in quite some time. think about it. It's, you come into tomorrow morning, again, the jobs report, as I was saying, if they're buying them tomorrow, be careful. Don't try to jump on the bandwagon tomorrow and think that the market's going to be bid drastically higher. Traders right now, okay, they might be looking for a bit of an exit. There's no panic. There's no volatility, okay? Come in tomorrow without making up your mind out there and get a good look at order flow early in the trading day. Thanks, everybody, for joining us here at TheoTrade. Have a great evening. Bye-bye.